Your high IQ is actually your greatest liability in the stock market. Brilliant minds often believe they can outsmart collective human behavior. They build complex spreadsheets to justify what is actually a gut emotional reaction, but the market does not care about your academic credentials. History is littered with genius-level investors who lost everything. Consider Sir Isaac Newton, one of the greatest scientists to ever live. He lost his entire life savings by chasing the South Sea bubble. Newton famously remarked that he could calculate the movement of stars, but he could not calculate the sheer madness of the people around him. The problem isn't a lack of information or analytical power. The problem is our ancient, hardwired survival instincts working against us. In the wild, running with the herd kept our ancestors alive. In modern markets, running with the herd will only get you trampled. To survive, you must learn to recognize these mental traps. Let's break down the 5 psychological errors that destroy wealth. The first major trap is the instinct to panic sell during downturns. When the market drops, our brains perceive it as a physical threat. Your heart rate spikes, adrenaline flows, and logic completely shuts down. You feel an overwhelming urge to make the pain stop immediately. So you hit the sell button at the absolute bottom of the market. You lock in your losses, turning temporary drops into permanent damage. Take the example of the market crash in March of 2020. Millions of smart investors panicked and moved their portfolios to cash. They watched in horror as the market staged the fastest recovery in history. They missed the entire rebound, leaving their wealth severely permanently damaged. The practical fix for this is writing a pre-looted investment contract. Write down exactly what you will do when the market drops 20%. Decide in advance to buy more, hold steady, or close the app. By making the decision now, you bypass your emotional brain later. The second trap is chasing recent winners instead of buying low. We are naturally drawn to stories of rapid, overnight wealth. When a stock shoots up, it dominates the news and social media. Smart people see others getting rich and feel a painful sting. They buy in at the absolute peak, driven by the fear of missing out. But buying after a massive run-up is like arriving late to a party. All the easy money has been made and the risk is now extreme. Remember the dot-com bubble of the late 1990s? People quit their jobs to day trade internet stocks with no earnings. They assumed the upward trend would simply continue forever. When the bubble burst, trillions of dollars of wealth evaporated. The practical fix is to implement a strict allocation rule. Limit speculative investments to less than 5% of your portfolio. Keep the remaining 95% in boring, diversified assets. This satisfies your urge to play without risking your financial future. The third trap is overconfidence after a few lucky wins. In a bull market, even bad investment decisions look brilliant. You buy a random stock, it goes up, and you feel like a genius. You confuse a rising tide with your own personal skill. This overconfidence leads you to take on massive, dangerous risks. You might use leverage, invest rent money, or buy on margin. But leverage is a double-edged sword that cuts incredibly deep. Consider the story of long-term capital management in the 90s. This hedge fund was run by Nobel Prize-winning economists. They believed their mathematical models had completely eliminated risk. They leveraged their capital over 100 to 1. When an unexpected market event occurred, the fund collapsed in days. They nearly dragged the entire global financial system down with them. The practical fix is to keep an honest investment journal. Write down exactly why you bought a stock before you buy it. If it goes up, check if it was due to your thesis or just luck. This simple habit keeps your ego grounded and your strategy honest. The fourth trap is herd mentality, following the crowd into hype. We are social creatures, and we hate being left out. When everyone is talking about a new coin or stock, we want in. But the crowd is rarely rational, especially at market extremes. By the time the crowd is excited, the asset is already overvalued. You are buying from people who are happily taking your money. Think about the tulip mania in 17th century Holland. People traded land, homes, and life savings for a single bulb. They assumed the price would rise forever because everyone else did. When the panic hit, the market collapsed to virtually zero. Wealthy families were ruined in a matter of days. The practical fix is to implement a cool-off period. When you hear about a hot investment, wait 48 hours. Do not research it, do not buy it, just let it sit. The emotional hype will fade and you will make a rational decision. The fifth trap is the disposition effect, holding losers and selling winners. We feel the pain of a loss twice as intensely as the joy of a gain. To avoid that pain, we refuse to sell our losing investments. We tell ourselves it is not a loss until we actually sell. Meanwhile, we sell our winning investments far too early. We want to lock in the win and feel successful immediately. The result is a portfolio full of losers and empty of winners. You are cutting your flowers and watering your weeds. This is the exact opposite of how true wealth is built. Great investors let their winners run for decades. They cut their losing investments quickly without emotional attachment. The practical fix is to use automatic trailing stop losses. Set a rule to automatically sell if an asset drops 15%. This removes the painful decision-making process from your hands. It forces you to accept small losses before they become catastrophic. To succeed, you must build a systematic, emotionless framework. Stop trying to predict where the market will go next. Focus entirely on controlling your own behavior and reactions. Automate your investments through dollar cost averaging. Set your account to buy every week, regardless of the price. This turns market volatility into your greatest financial advantage. You buy fewer shares when prices are high and more when they are cheap. It is simple, boring, and incredibly effective over time. True wealth is not built by outsmarting the stock market. It is built by mastering your own mind and staying disciplined. If you want daily insights to master your money, subscribe to Mr. Net Worth. Let's build your financial freedom, one rational decision at a time.